Okay. All right. So it looks like the screen is still working. All right. So let's go over the rules that I discussed earlier for how we will look for trades. Okay. I did write that down, put that in the chat so you guys have a copy of that. But let's go over this really fast. All right. So let me paste this here. All right. So here are the rules. Okay. Rule number one. Now, this was a reply to one of your emails. That's where this came from. It's actually from one of the newer funded traders. And I said I wouldn't worry as much about getting a good entry, but having a very clear context for when trading is valid and when it is not. Here are the rules I advocate in the coaching room. Now, let me just start off by saying this. I'll just make sure I say this now. There is no single way to make money trading, meaning that there are different ways that you can achieve it. There are different strategies that actually work. Some of those strategies actually are opposed to each other. In other words, some strategies are designed to anticipate the turning of a trend. So they would literally take a position in anticipation of a turning point of the trend. Whereas other strategies will only trigger when a trend is believed to have qualified to have the right amount of strength to persist, right? So it may appear that those strategies, if one works and the other can't work, but that's not true. So for a strategy to work, the only rule that is universal in trading is that you must make more than you lose. Now, whenever this is brought up, I understand that in the mind it's like, yeah, duh, I already know that. Duh. Of course I got to make more money than what I lose. I know that already. Okay? So the natural reaction will be, I already know that. You don't have to tell me that. I already know. However, as I always say, there's a massive difference between what you do and what you say. What I believe in my mind intellectually is one thing. What I will actually do under pressure is another. So, in theory, a person can say, if I were there, this is what I would do. Most of us, when we look back in time and we look at situations that we feel people did something wrong as a group, maybe we look back at Nazi Germany and we say, I wouldn't have done that. I wouldn't have been like that. But how do you know? The only way to reliably conclude that you might not have gone along with that is how you live now, observing the things that you actually do in the present when are you a person who can consistently resist pressure to conform when you don't believe something is right? Okay. So if I think something is wrong, right? If I think something is unjust, but everybody around me, friends, family, whoever says the opposite, am I able to stand my ground and still hold to the belief that I hold that this is something wrong, right? So if a person does that in the present, perhaps, not guaranteed, but I would say there's a good chance that that person would do the same thing if they were in a different time under different circumstances, but similar pressure. So in other words, everyone can easily tell you what they would do and how they would be when the circumstances are not in front of them. But once you actually are in those circumstances, people tend to act a lot differently than they think they would or what they claim they would. And I don't think it's because they were lying. They believed what they said. It's just once the situation arrived, they suddenly realized that their convictions weren't as strong as they said. I mean, there's obviously, like, to use a story from the, like, there's all sorts of things that, stories, where you learn about people who, betrayed other people, and they were loyal and everything was fine, and then one day they changed. Stuff like that happens. But a lot of times it blindsides us because we're not thinking that we would ever respond the way that we do. But then we find ourselves doing it. So when I started off with with Great Point Capital, GPC, right? When I was there during the first week, which was, I would just call it the orientation week. During that first week, Gabriel, who was the manager there, and he's now the vice president there, he said, at some point, you're going to be going up the mountain, and at some point, you're going to be like, I can't go any further. Because if you just push a little more, you're just about to get to the other side. He says, so at some point, and he said, it usually takes 6 months for most people, where you're going to get to a point where you're going to be convinced that there's no possible way anyone can do this. There's no way it's possible for anyone to make money. It's all lie. It's all farce. And then you'll push through, and eventually you'll get it. He said, but that's the thing. Most people don't push through that last part. They give up just before they're able to survive or to thrive. We've all heard that analogy where the person is digging for gold and they give up just before they're about that one more stroke and they would have had it. Now, obviously, there's nothing you could do about, you can't persist at something forever. I understand that. So I'm not one of these people. It's like, hey, spend the next 40 years of your life trying to make this work. I wouldn't say that. But what I'm saying is that if you're struggling to profit, if you're struggling to make money, to be able to, consistently figure out how to bring profits out of the markets and to minimize losses, eventually you'll get it, but you have to apply yourself in the way that's most likely to generate good results. So that's why I put this out there, that number one, we're only looking for stocks that begin the session with a strong movement up or down and away from the YCTO, which is the price range between the previous day's close and the current day's open, which is represented on my charts. Red line here represents the previous day's close. So that's the YC part, yesterday's close. And the green line represents TO, today's open. Yesterday's close, YC, today's open, TO. Okay? Now that's what I call it. If you Google that, probably it won't show up anywhere because, as far as I know, I'm the person who coined this. I didn't come up with the concept, but I'm pretty certain that I'm the only person calling it the YCTO. Might be wrong, but I never heard anyone else say it, so I just called it YCTO because it's easy to remember. Yesterday's close, today's open. Now, other people will give it another name. They'll say the gap, which is what it is. Another term used for it, which is an accurate description, is the gap. It's the gap between today's open and yesterday's close. Everybody knows about this idea because all of us have seen it before. So we all know that there's usually a gap between the previous day's close and the current day's open. We all know that exists. So we'll say a gap fill means that the stock, let's say, gaps up. It was down here when it closed the previous day, and then after gapping up, the stock eventually comes down, and we call that a gap fill. Okay? This is something a lot of us have heard about before. Some of us have used. There's all sorts of ideas surrounding it, but the point is, I'm not looking for a gap fill. I'm looking for that gap to stay exactly the way it is, and the stock just moves away from it. Now, sometimes a stock starts off with the gap down and then quickly goes up. DraftKings, I think, yesterday was like that, or I forgot what stock it was, but one stock was like that. So, in other words, the stock opens down here, then immediately goes up, and then goes up from there. That's fine too. But the key is it has to break away from this range quickly. So, whether it starts inside and quickly breaks away, or it just starts the day breaking away up or down, we want something that early in the session starts to move up. So that stocks that begin the session, meaning that we're not waiting an hour, we're not waiting a half an hour. In the first 5 to 15 minutes, there should be clear evidence of which way the stock wants to go. Those are the ones we're going to look at, the ones that show clear indication of where they want to go in the first 5 to 15 minutes of the session. Okay? So if something starts to move well, but it's hours into the session, that is not something that we're looking for. It is possible to make money off of that, just like it's possible to make money off of a stock that does a gap fill. It's just that we're not looking for it. Why am I not looking for it? Because as I said, we want to focus our attention on the low hanging fruit, meaning that you're trying to get to the point where you're a professional trader. You want to be able to do trading well enough that you can reliably make money over time. You're not going to start this business at your maximum skill, at your maximum efficiency, but you're trying to get to that point. You're trying to get yourself to where you're able to make a lot more money. But in order to make a lot more money, you first have to learn how to make money, period. The most important lessons in your trading career are what you're learning now, because these are the things that are going to give you the only foundation you'll ever have to build on. So if I can't figure out how to make money in situations where there's a strong trend, then I'm not going to be able to figure out how to make money in situations where there's not. Now I can tell myself I will. I can tell myself, nope, I don't need that because, yeah, so what, the stock keeps going up or keeps going down. I don't want to trade that because, how do I know it's going to keep going down? But let me look at a stock that's doing this, and I'm going to suddenly pick that it's going to go up to here or go down to here. And that's the part that gets me because I'm like, you know what? Isn't it easier to see a stock on a trend and it has a pace, it has a rate at which it's climbing or falling, and you can easily say, all right, well, if it keeps going at this pace, this is probably where it's going to end up. I mean, if we didn't know that cars had brakes and we saw a vehicle approaching us as we're crossing the street, if it approaches us too quickly, what do? We panic because we're like, whoa, it doesn't look like they're going to slow down. Now, it doesn't mean they can't. We know that they can actually slow down at the last second and still successfully stop before they cross the intersection. But the point is, as a rule, when we see a car approaching the intersection and it doesn't appear that they're going to slow down, we anticipate that they're going to hit us, so we get out of the way. And if the person suddenly stops, we give them a mean look, we may give them a mean gesture, we may say something to them, but why? Because we're angry, we're saying, you blah blah blah, you shouldn't have done that. Then you see me standing here, you scare me half to death. I thought you were about to hit me, right? Because they didn't follow one of the basic rules, which is when you're approaching the intersection, you know people are going to cross. Don't rush to it with your car and scare people. It's rude. It's inappropriate. You're supposed to slow down noticeably to make sure the person knows that you're aware that they're crossing the street and you're slowing down to make sure that they don't worry if you're going to run over them or their kids or their dog or whatever, right? So we anticipate that. We see how quickly something's approaching and we judge whether or not we believe the person or thing is aware. Just like today, I was riding my bicycle. I went to a quick meeting. Hold on for a second. Um, so with that being said, if I'm looking at, a normal scenario, if I see a vehicle approaching an intersection quickly, it's going at a rapid pace, I'm assuming they're not stopping, and I make a projection after a certain point, you can realistically say if they hit the brakes right now, they're probably going to end up stopping this far ahead. How do I know you can do that? Because you do. Hold on for 1 second. 1 second. Sorry, guys. 1 second, guys. All right. So if I am looking at something, right, and I notice, a car, and I notice that it's approaching too fast, I know I can guess how quickly it can stop because I've driven before. You've driven before, so we have some idea. So if in other words, if you're approaching an intersection at 100 miles an hour and you're within 50 feet of the intersection, you can't stop that fast. No car can stop that fast that I'm aware of. I don't even think an F1 car could stop that fast. So if I'm hitting 100 into an intersection 50 feet away, yeah, the car is not going to stop. It's going to go into the intersection, period. Right? So at that point, everyone knows, yeah, that car can't possibly slow down quickly enough. Right? That's just anticipating um, based on what we based upon what we're what we're our experiences are, etc. Now, so if I see a trend and it's going up and everything looks good and fine, then all right, well, I got a trend, it looks good, everything's working. So if I make a attempt to trade that, that's much easier to anticipate what will probably happen next than it is to look at a stock that's really doing nothing. So if I have a stock that's doing nothing, right, it's just going sideways. Let's delete these for a second. If I have a stock that's doing like this, right, if I know there is resistance up here and there's support down there, I have to wait, of course, until the stock gets to one of those before I might be able to do something. So let's say I wait and the stock goes up to resistance. All right, well, now I've got an opportunity to perhaps do a trade. But the next question is, once it hits resistance, where do I think it's going to go next? Or for me to answer that question, I have to have data. I have to know where the stock usually goes when it fails against a resistance or support. So I have to have something that I referenced. I mentioned to you guys that a lot of times if a stock goes beyond the T2 target, let's say this is T2, and it goes beyond that, and at some point it runs out of momentum, when it turns around because it hits some resistance up here, right? It hits some sellers up there. Wherever the volume weighted average price is, let's say that's it right there, that's probably where it's going to head. That's something I know because stocks tend to go back towards their VWAP as you get further into the day. So they'll make their big moves and then eventually they'll start to come back towards it. And in the case of such an extreme move up, there's a very good chance it returns back to the VWAP. So that's where I would get that idea that I would say that's as far as I think it might go because that's something I can quantify. It's something I can look back in time and measure the degree to which that occurs. So thinking about that way, if you know, okay, if you know that something is likely to happen, much more likely than not, and you know what circumstances it happens in, that's something you can exploit. So it's nothing against any other type of trading, but what I'm saying is if you're going to trade support and resistance, then obviously you have to know where they are, and you have to wait for a stock to get to those points. And then you could obviously do trades off of that, which is fine. I've done that type of trading. In fact, A lot of times I end up doing that type of trading. But for our purposes here, the reason I'm focusing on this is because, again, it's much easier to be able to do that. So if I know I've got a deadline, if I know I've got a time, let's just think about it this way. Forget about the amount of time that you've bought for the program. Like you have a 6-month program, you have a 3-month program, whatever you've got, right? If you've got a program, or I should say 6-month program or 1 year, but if you got the program, right? You have our service. You get into it, you join. All right. The first thing I'm thinking about is this. I want to become a professional trader. So what is the most direct path for me to get to that point where I can start trading professionally, make some money that way, and then gradually build up my repertoire, gradually build up my toolkit of trading strategies. In other words, I need to learn something that I can do now, that I can do effectively, where there's lots of opportunities, enough where I can exploit them. Let me learn that first, get it down, and then move forwards from there, right? So if I want to become a BMX rider, like a championship BMX bike rider, and I go to all these shows and I do all these backflips and all this stuff, I first have to learn how to ride a bike. What's the point of me spending all my time learning about how to do a backflip and how to do this trick and that trick if I can't even ride the bike yet? If I can't ride the bike and do the simplest task of riding a bike, which is just to get on it and keep it upright and be able to steer, that means I can successfully navigate with a bike. I've learned how to ride. Once I've learned how to ride, only then would it make any sense to go the next step, right? Now, it's only the next step which basically says, all right, well, now I've learned the basics. Now I got to learn some more things. So you learn a few more things. And eventually, you get to the point where you can actually start learning some serious maneuvers on that bike. But it's just like anything else. If I want to go to car racing school, right? If I want to become a car racer, I got to first learn how to drive at a basic. I have to be able to drive with a high degree of competency first in a regular environment. There's no possible way I'm going to start off not knowing how to drive. I'm just going to go straight to racing school and figure it out then. No, everybody who's there already knows how to ride or drive a car. They all know already. They've been driving probably for years. So now when they go to that school, they're not learning what is a steering wheel, what is a gear shift, what does it mean to reverse or brake or what. They know this stuff already. Now they're building up from there. So what we're doing is we're focusing on the thing that you can do that's easier to find when you're just looking around. You find stocks that are on good trends. They give us opportunities because we have setups like, up, pull back, resume, or up, pause, resume. We got those down. We know that's pattern 1, that's pattern 2. We got them memorized. We know what they are. We know that we should be looking for that. We don't always get it perfectly. We don't always see exactly what's there. But because we're looking for it constantly, sometimes we're going to see something that looks clear to us. Other times we won't. But there will be enough times where we can actually profit. So that's why. We're only going to trade in the direction of the strong movement because, again, we're trying to take advantage of something that shows its intentions early. So rather than looking at something that doesn't look that clear and we're trying to guess when it's going to move, how far it's going to move, etc., we have something else that actually shows us a pace. It shows us its momentum. And it shows us, which direction it wants to go. So now we have a lot of information up front that we can utilize to help us make money. So we only want to trade in the primary direction of the trend. So if the market, if this is the YCTO and the market opens this way, then we're only going to be a buyer. If the market opens that way, then we're only going to be a seller, which means if the trend reverses and starts to go back, we're not doing anything with that. We're leaving it alone. We're moving to something else that is. Now, again, there are many different ways to make money. The best question you want to ask yourself is, if you're really determined to do it differently, ask yourself, what type of success have you had doing it the other way? In other words, if you say I trade based on, Fibonacci's and things like that, okay, tell me, or tell yourself, not necessarily me, but tell yourself, what are my stats like when I do this strategy? Am I really doing well? Am I making money? Do I see a consistency where I'm bringing in more profit than I'm putting out in losses? Is that something that's sustainable? I've been able to do it for a while, not just for a day or a week. It's not something I'm just experimenting with or trying to figure out, or I'm switching up. I was using this charting package, now I'm using that charting package. I was using these signal alerts from this service. Okay, now I'm switching to these. This is not the time where you try to figure things out from scratch. The purpose of having this challenge is that you're being guided in a direction that will get you to where you can be a successful trader. So when I asked Ben, the guy who mentored me to some extent at Great Point Capital, I mean, he did mentor me, but as much as he felt like his time was worth, right? And you have to respect that, because Ben puts time into helping you trade, and then what benefit does he get out of it? In other words, what will he get back? Am I going to contribute to the pool of information so he can profit too? That would be the big question, right? He gives up everything and he gets nothing. I mean, unless he's just some benevolent person who doesn't care, then it wouldn't make a lot of sense for him to keep doing that, would it? So that being said, we do need to think about how we're going to get to the place that we want to be. Now, this program, you're being guided in a direction. And when I was working with Ben, he just basically said, hey, find a stock that's in play. And what he meant by that is very simple. Find something that has a reason to move, or at least looks like it has a reason to move. Okay? You may not always know why a stock's moving, but you can clearly tell when a stock has something driving its price, because it doesn't act normal. It pushes harder, more consistently. There's lots more bias in one direction. So a lot of times we find out weeks or days or even months later why something was up or down so much. But the reality is, if you've watched stocks long enough, you'll be able to recognize the difference between something that looks normal and what does not. And basically, I'm describing it to you. I'm telling you that if you see something that starts the trading session right from the first 5 to 15 minutes, this thing is pushing hard up or pushing hard down, that's something going on. Something's happening with that stock. And the more persistent it is, sometimes you get like this really straight drop down or straight rise up, and then the stock doesn't do much after that. But if you get something that starts off and it's just a very consistent trend up or very consistent trend down, pay the most attention to those, because those are the ones that are likely to pay you the most money. The ones that just keep soldiering ahead, like AMD did yesterday. AMD started off a little rough. As I told you guys, it was lots of chop in those moves up. So it had big swing up, big swing down, big swing, but it kept pushing. And eventually that volatility died out and it emerged into a very clean trend that had very little deviation in its price, which made it vastly easier to trade, vastly clearer when things are breaking down. Because if you got a stock that just keeps going in a straight line, then suddenly it does this. It's not like you miss it. It's not like you can't see it, right? You see it right away. So if I have my stock and it's doing this, and all of a sudden it goes bink, everybody sees that. Everybody knows, wait a minute, that doesn't look right. I got to reduce my position. I got to get out. I got to do something, because everything was great here, and now it just drops like a rock. Yeah, I'm out. Or I'm reducing my position. Only the people who are absolutely determined that they got to be convinced that there's got to be more. No matter what the stock does, they got to stick around, because they just know it's about to do this. In other words, these are the GameStop people. These are the AMC people. These are the BBBY people. If you are one of them, I mean, it is what it is. But what did this group of people have in common? What they had in common is they could never accept that it was over. This stock gone. Let's see, where's AMC at? I haven't even looked at it in so long. AMC, where is it at now? AMC is down at $4.11. Okay? $4.11 after a reverse split. Let me repeat that. It's at $4.11 after a reverse split. Okay? Now, anybody want to be brave and volunteer to, if were you in AMC and you lost money? Anybody want to acknowledge that you were? I'm just asking for a reason. I want to go over something about the thought process so you can actually benefit from it. If anybody wants to admit that they were, I was not. Okay, I literally skipped this thing altogether, but some people were. I did have something in GameStop long before the big spike. I was bullish on it, but not for the reasons a lot of people were. I thought it was oversold. That's all. Like, not technically, but just in principle, I thought the pressure was too much. Okay, anyway, so no one was in AMC. All right, not a soul. I doubt that, but okay. Now, here's AMC. Everybody can hear me okay, by the way? You guys can hear me? Yes? And I saw Michael, you typed something, just making sure we're still here. Okay. So let's talk about something. AMC went up, right? Now, when it was bullish, there was no shortage of people that I could find who couldn't stop talking about it, right? There was no shortage of people who were talking about this. The stock had everybody talking about it. So did GameStop, so did Bed Bath & Beyond. You just had absolute ironclad, rabid, just unbelievable levels of belief. I'd never actually seen anything like that since or before. There's no situation I've ever encountered in the entire time I've been in the markets that compared to the fervor, the absolute unquestioning belief that I saw for this stock, GameStop, and for which doesn't exist anymore, Bed Bath and Beyond, right? They did go out, right? Yeah, 2022. So let's just think about this for a second, guys. Why? Why did people do this? Why wouldn't they get out? The reason why they wouldn't get out is because they had a hope. They had a dream. The dream was, I'm going to make all the money that I wanted to make in my lifetime in one trade. That was the dream. I'm going to make it all one trade. It may sound funny, Walfred, but does anyone doubt that that was what people were thinking? Does anyone here seriously doubt that that was that? Yeah, okay. But that's what people thought. I am going to make all the money I ever wanted to make in my life, right? I'm going to make it all in this one trade. That was the belief. That was real. It was tangible. People believed it. It was, dare I say, religious in nature, right? This was a religious kind of thing. Maybe a religion is not even that's probably being unfair to religion. So let me take that back. It was more like a cult. This was a cult-like belief. What makes a cult a cult? What makes a cult a cult? I mean, people throw that term around, and I think a lot of times they throw it around inappropriately. But truly, what a cult means to me is when someone has a belief that's so strong that nothing, it doesn't matter if the thing is self-contradictory, everything is wrong, they can't even acknowledge any flaws in it. There's nothing wrong. There's nothing ever wrong. Nothing ever wrong. Sorry. Nothing ever wrong. What that means is the cult is flawless. It has no shortcomings. no omissions. There is nothing that's ever wrong about it. People often do this when it comes to politics, and I would love to say it's a one-sided thing. It's not. People do this with politics all the time. Their side can do no wrong. Now, I understand that politics is more like, teams. You got your team, I got mine. I get it. But what I'm saying is it's impossible for any political party to do everything right. It's impossible for them to even do probably most things right. There's going to be tons of things that are done wrong because it's inevitable. How could you know everything anyway? But politics being what it is, no one ever apologizes for anything. All they do is point to somebody else. So in that sense, politics does actually engender cult-like thinking because it discourages you from questioning anything about the party. The party is right, the party is good, the party does no wrong. And if they ever get caught doing something wrong, it was just somebody, this rogue agent that was in the party, and it has nothing to do with us, and it just, let them go. Throw it all on the person, let them go. That's the idea. Squeaky clean, nothing wrong. It's all everybody else's fault. Don't believe the opposition. We are the truth. We're the everything. Us, right? So these guys took that and took it to a whole different level when it came to AMC, Bed Bath & Beyond, and GameStop. Like I said, I've literally never seen anything like it. And whenever at the time I made the mistake of pointing out something that was erroneous in the thinking, what do you think happened? Everybody turns and they just attack you, right? If this was a physical thing, they would have beat me to death, no question about it. I mean, they must have been hearing heresy, right? Literally, like this is like stone him, get rid of him, that sort of stuff. I mean, like that's the truth. That's the way they felt. So when you have that level of belief, no matter what this chart does, all you see is this is where it is now, but it's going to be, higher than high. Like it's, whatever that number is here, it's going to be 1,000 times that. It's going to be trading at $20,000 a share. I remember people saying stuff like that. $20,000 a share. I specifically remember people saying that. And I'm thinking, like, how could a company possibly be worth that much with that many outstanding shares? What could the business possibly do to justify valuations in the trillions of dollars? They were basically saying that a lot of these people didn't even realize the numbers they were saying would make these companies worth basically 10% of the entire equities market. Like how could it be worth that much? But the reason why is because it didn't matter. It was, I believe this. I think it's going to make me all the money in the world. It's a one-time thing. This is going to make me rich. Everybody's agreeing with me. And anyone who doesn't, they're haters. We're diamond hands. We hold the line. We don't move. We don't budge. You're just a hater, and you're a shill. You're working for the hedge funds. I mean, it just blew my mind. But it was real. So even if a person didn't go that far, because there was so much social pressure, people still got into it, even if they didn't believe that much. It was just what if it actually happens? What if they're right? I can't miss out. I got to be in. And of course, there's still people who held this to its end after it peaked, right? That went bankrupt. GameStop is still around. Yeah, crypto has done the same thing. To be candid, crypto definitely has done the same thing. Lots of crypto products are just BS, to be honest, but they do have a practical purpose if they're utilized correctly. It's anonymous money transfer or untraceable money transfer. Well, it is technically traceable, but it's anonymous. So here's GameStop. Here we are at $14. The corrected high after they did the they did a split, so it would have been higher. It was like 500. It was like what 500 or whatever. Now it's 120. But obviously, the stock has lost the vast majority of its value. I've been to GameStop stores. My nephew said that people still go to GameStop because he went there. He's like 17, so I guess there must be some business still there. But I mean, I'm looking at it like, well, that's nice and everything, but is that enough to keep this thing alive for the long term? And my conviction is no, it can't be, right? So with that said, in my mind, while yes, this stock, it could be something. This company might survive. They might actually end up doing something. I don't see them as it's not like there's any good chance that this company is really going to turn around much. I mean, its business model cannot be radically changed. It's just a matter of whether people gradually turn back to wanting to go to stores or not. If they don't, then I guess that's that. Okay, so that's where we stand on GameStop. And then if we look at the last one, AMC's corrected price after the reverse split, $726 a share, currently at $415. The company has failed to do anything to change its situation. It's progressively gotten less valuable. So if I'm thinking about it, this is another example of something that no one was willing to give up on. Now, how does this connect to what we're talking about now? The way it connects is if I'm getting into a trade, right, I have to understand that the only thing I'm interested in is that the movement keeps going my way. The moment it doesn't look like it is anymore, I have to exit and I have to get out. I can't keep projecting in my mind some future profit that's not materializing. If I start to commit myself to one direction of the market, which is fine, but once the market's not playing out the way that I expect, I have to be willing to accept that quickly. But once I start putting in front of myself beliefs about, hey, this thing's got to go up, I'm going to make so much money, it's going to go my way eventually. I have to believe in it because I did the research and it must work. Once we start ignoring what's happening, and just keep reinforcing in our minds the desire to stay in the trade because we're hoping this one is going to be the one that's going to do something, turn everything around, we're making a mistake. No stock is really going to do that for us. Some people got lucky and they got into this when it was really cheap. It went astronomically higher. They happened to sell when it was high, and hopefully they kept all that money and they never took a chance on it again. Obviously, we know most likely they didn't, but assuming they did, then they may have walked away. But that's basically being at the right place at the right time where you lucked out. Anyone who tells me that they just knew this had to happen, well, you expected it to happen, but the truth is it was never a guarantee. It just happened. You happened to be in the right place at the right time. And if you knew that, then you probably did much better. If you didn't know that, then you probably did much worse. In other words, those who realized they got fortunate are the ones who probably walked away in the best spot. Those who thought that they were skillful, craftful, they knew it all along, they knew better than everybody else. Wall Street was wrong, the government was wrong, all these people who deny this are wrong. I know what I'm doing. We all know what we're doing. Well, those are the people who probably held and probably are still holding now, right? Okay. So, what we're trying to do is get into a trade where something has a bias, shows its trend, but we only stay in it for as long as it continues to move in our direction. We don't stick around and indefinitely stay in. We have to know that there's going to have to come a time to get out, and we have to be willing to do it, not just keep looking at it and saying, hey, it's going to come back. We try to get in where stock pauses and then resumes. That's easier to recognize. It's easier to recognize where to exit when you have a trend like that, because when you're looking at it and it's going like this and like this, it's much easier for me to detect that if a stock retraces to a recent swing low, if it does this, it's much easier for me to recognize that than it is if I'm looking at a stock that's kind of going like that. It's like, well, where do I exit? Is this my exit? Is that my exit? Is that my exit? Like, where do I get out? This is much easier because it follows a very good pattern, a clear pattern. So that's why we're looking for stuff that clear pattern, much easier to figure out, right? Now, we exit whenever the movement fails to the best of our ability, to the best of our recognition. Again, there's no reason to obsess over a perfect entry because you're almost never going to get it. What you want to obsess about is moving out of a stock when you're losing too much money. You have to put more focus and have to understand that it's the exits, and I said this already, but I'll say it again. Your exits are basically what's going to make or break you. Okay? And by exits, what I mean is you have to be willing to pull the plug. You can't be of the mindset that I'll just keep holding and holding and hoping it comes back, and then eventually you give up and say, okay, fine, it's not winning. Better to get out, wait for a better opportunity to come your way. Okay? We can't really make money if we're not willing to exit. We have to be willing to exit because no stock is going to go well enough where we don't have to worry about that. And then finally, we reduced our position sizes during pullbacks in a trend, meaning that as the trend starts to pull back, hopefully it does it slower than faster. We can reduce our position size, and then once the trend resumes, we can again re-up to the normal share size we're at, and potentially, if it really goes well, we might be able to add even more shares than we originally had. So the point is, when we're trading, we're looking for the primary trend direction. We identify it, and then as the stock is pulling back, meaning that if it's going up and I'm winning, then it starts to pull back. This is where I reduce my position size, and I do it rapidly until eventually I have no position left. And then when the stock starts to resume, if it gets back into a trend, then somewhere in here, this is where I restore to my original position size. So in other words, I might have 100 shares here. I might be down to 20 shares by there. And then I'm back up to 100 shares over here, right? I'm breaking. In other words, just like a car, when I'm reaching a place where I can't keep going forwards, I slow down, stop, and then once things progress where I can go faster again, then I speed up. So the number of shares you have basically dictates how much the market's going to affect your account. So more shares, more impact on my account. So if things are going the wrong direction, I want to reduce my share size down. And when they're going back in the right direction, I want to put it back up to where I think I'm comfortable with. Options, you don't really have to reduce your position size in options because Delta is already doing that for you. Delta is not constant, it's a variable. So as the stock goes your way, the delta increases. As the stock goes against you, the delta reduces. Delta basically should be interpreted as a correlate. It's equivalent to shares. In other words, an option has 100 shares leverage, but if my delta is 50, then that means I have the equivalent of 50 shares of the stock. Okay, so with options, you don't really have to reduce your position as it pulls back because, again, the options are already going to do that. The only time you may have to do that is if you start off with a lot more options. If you did, and if you have a lot of options on and your P&L's doing like this, then you got to reduce it anyway. So you shouldn't be in a position that's so large that a small pullback is going to have a substantial impact on your outcome. Again, as the market's pulling down, the options will lose delta, so the move down will be worth less than the move up. So I'm making more as it moves in my direction on calls than I'm losing when it moves against me. For the same distance, I'm losing less than I'm making when it goes that distance. So if it goes the distance in the wrong direction, I lose less than what I make if it goes my distance in the right direction. So options does make that part easier because it automatically adjusts its delta exposure to the market as the stock moves up and down. So for options, the main thing you're concerned about is whether the overall trend is still moving in that direction. Once it starts to go the other way, you got to exit just as surely as a stock trader has to exit. So for options, once you're in, as long as things are not going too far in the wrong direction, you stay with it. It's going to fluctuate, but it'll work out better for you because you don't have to do as much trade management. You just have to make sure that once things start to look like they're not going up anymore, if you're bullish or down anymore, if you're bearish, then it's time to exit. For stocks, you do have to modify your position size, just like you have to moderate, your accelerator and your brake when you're driving. Then you're going to have to add, accelerate, or reduce, brake your position. So when it's coming to a turn, just like with a car, you come to a turn, what do? You slow down from the high speed you may have been going into it because you can't go around that bend as fast as you can go straight. Can't do it. No matter what car you have to slow down if you're at speed going through a turn. So when we're going up and we start to pull back, think of that as a turn. I reduce my speed, meaning I reduce my trade size. And then as it starts to resume, I go back to the accelerator. I increase my steer size. So I accelerate, I brake, I accelerate. I keep my position size, maybe even add to it. Then I reduce my position size. Then I increase my position size over here. What delta drop do you decide to sell off your options? It's not the delta drop that's doing that. I'm looking at where the stock is going. That's it. If the stock starts going the wrong way, it's time to get out. Deepa, so it's not me tracking delta value, it's me looking at what the stock is doing. If it's not continuing to go my way, then I get out. If I got puts, the stock's going this way, then I got to get out. If I got calls and the stock's going up and then it starts to go the other way, I got to get out. So you look at what the stock's doing, and when it's not doing what it's supposed to, when it really breaks trend, then it's time to exit, etc. Okay? Time to exit, time to exit. It takes time to get good at figuring out how far is too far of a pullback, though I understand that. But the point is, if you're not getting out at any realistic point, in other words, if you have to, just like braking a car, the first time you try it, you brake too late or you brake too soon, right? First time I tried braking ever, when I was driving the family car, I first stopped too late, then I stopped too soon. Then eventually I realized that you don't have to stay on the brake the whole time. If you release it slightly, it lets the car keep drifting forward. You press it again, it starts to slow down some more. In other words, eventually you learn how to moderate it where you don't suddenly abruptly stop or you never stop. You learn how to moderate the brake just like you learn how to moderate the gas. So all of us have the skill to be able to do this because you're able to drive cars and stuff like that where you have much more things to risk in terms of your life and your well-being than you would in trading. Losing on a trade is not the same as getting hit by a semi truck. Okay, so my point is, you already understand the basic logic of this, and learning how to exit at an appropriate time is something that only comes about if you actually put that into practice. You start exiting. Eventually, you'll get better at recognizing when you can afford to stick around a little longer or where you need to get out a little sooner. Just like at the car, eventually you'll get good at recognizing when you have to brake harder or when you don't have to, when it's time to avoid something or when you should wait. All those things you learn by doing. So the more you trade and try to apply these principles as best you can, the better off you'll get because you'll see your stats and you'll learn how to adjust what you're doing to improve your stats. But if you don't apply anything, if we're just sitting there academically discussing the reasons why I should do X, Y, or Z, but I'm not putting it into practice, I won't learn it. Learning comes from doing it. There you go. So, as Adrian said, I've increased my win to loss ratio from zero point 0.8 to 1.44 applying your exit lessons. There you go. Now, notice what Adrian said. Adrian didn't say anything more than I started applying what you said. Now, he's not the only person here. There's tons of people here who have already done this. There are lots of people in this room who had win to loss ratios of 0.6, 0.7, struggling with that. And a lot of you are now consistently batting 1.3, or sorry, win to loss 1.4. Some of you are at 3, right? And I'm just pointing out that this is not because you suddenly discovered a new formula for, well, I guess in a sense you did. It's not like you found a new trading signal or a new chart pattern. What did you do? You just learned to exit when you're not winning, to recognize that, yes, there's no point in me sticking around if I'm not seeing the results that I want. I need to get out of the way, right? Well, your batting average may suck, but that can be improved. The first step is to control the win to loss ratio. So I'm glad you did that. And you never want to backtrack on that. You have to stay consistent with understanding that you still have to control the downside. Now, improving your batting average, that's where now you're at the point where you're going to start improving your timing. Now, or at least improving your selection process. Okay? Now you're at that point. But before you could even advance in that point, you still have to get down the first part, which you have done. You just can't go back on that. You have to stay consistent on managing that win to loss ratio. So that way, once you figure out better ways of approaching it, you'll get better at making money. If I'm not sure what error message it's giving you, but if it's saying it can't open, if you have Thinkorswim on TD Ameritrade, you can do the NASDAQ scan. That's where you actually have the links to open shared items in Thinkorswim, if you are familiar with that. But I'll see if I can. I don't know if I'll see if I can find another way to get it to you. I'll just have to locate that on my computer. Hmm. Well, those methods are proprietary, and since you're going to be trading for us, then it won't really matter because as long as you're here, you have access to them. So you have to think of it that way. The information I'm sharing is what you will be accessing as a member. I have already started the process of creating a way to get those. Well, yeah, that's why I'm providing it, because if you're trading for us as a proprietary trader, then that's what you're going to have access to. So, as far as the other way of getting access to it, we're in the, yes, it is. We're in the process, my company, not Funder, but my company, I'm in the process of working with a developer who who says that, within maybe a couple of weeks they'll be able to do that, where I can just send out a list of all the calculations every morning. So as suppose it has to wait till market open. I can't calculate before then because it's based on market open. But the once the opening is done, I just told them within 2 minutes or less, I need to be able to publish that. So what I'm going to do is publish that to Substack. It's not ready to go yet, but I'll just publish it to Substack, and then you'll have all that. Yes, because it's not something provided by Funder. It's provided by me, so therefore it will be separate. I mean, if Funder decided to include that as part of a package, they could, but they would have to pay me for it. So that would be the only way I would do it. So anyway, it's not going to be something crazy expensive. So just to be clear, Substack is a place to publish articles. It's just an article publication site. So I have to, so basically the results have to come off the algorithm. It has to calculate quickly and send the information to a document, which then gets published. So I can send the information to Google Sheets, which I can update automatically, but I still have to get the data, and that's the part that takes time. So we have a developer that's working on that. Supposedly they're going to be done pretty soon here, but we'll see. Okay, we'll find out. He said it'll take him about 2 weeks. It's been about a week, so we'll see. All right, so that's the objective. Maybe eventually it can be done a different way, but that's the best opportunity I have now. Now, are there other ways to calculate reward to risk? Yes. The other way to calculate reward to risk, which is going to give similar outcomes, is Bookmap. If you see where support or resistance is on a graph, then you already know where possible support, you already know where actual support or resistance is if the stock gets there. But T1 and T2 are a little more accurate as far as projecting where something will eventually go. So in other words, if I've got DraftKings in front of me, if I can see the areas of potential where the resistance will be if it gets there, and support when it gets there, and these are places I can target. If I see a trend going up, I can say, okay, first place is probably going to be where the first resistance is. Okay, it got there, and that's the second one. Okay, it got there. Here's the third one. So you have that too. Okay, you have that too. Both of those, obviously, both of these have their pros and cons, but either way, the information will be made available. So the Substack thing, like I said, it's not really about making a lot of money off of you guys doing that. It's just it'll be something really cheap. But like I said, if they want to incorporate that into Funder as a part of your subscription or whatever, that's fine. We'll work on that. But other than that, that's that. All right. All right. So, having said that, I got to run here, folks. We got today's group. For those of you in the group mentorship, that's on Zoom. Danny should have already sent you a email. If you haven't gotten that from Danny and you're in the group mentorship that starts today, let him know, and then he'll get that out to you. But otherwise, I'll see you there in the Zoom meeting in about 23 minutes. We'll go from there. Mm-hmm. Wait a minute. I did a quick spreadsheet calculator for stops based on absolute dollar loss by contract size and also for ATR. I am happy to share that. All you got to do is email it to me, and I'll share it with the room. So just email it to me, and I'll put it into the folder at the bottom right. Yep, no problem. All right, folks, have a good one. See you guys tomorrow. We'll go from there. Okay? Take care.